Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Hormuz Fatakia. Things look very, very quiet, right? Though beneath the surface, underneath, there are so many individual stocks where you are seeing some big moves. So in the frontline pack, it's HDFC Bank, which is leading 4% up. Bajaj Auto has staged a recovery after last week's drubbing. Eicher Motors moving up. Tech Mahindra, where the numbers look good, that's a stock where there is buying, and even Wipro, because in the large cap space, the analysts like Wipro's Q2 performance and valuations are supportive. Heavyweights like L&T, Reliance Industries too, fighting for the bulls. But on the way down, markets are really punishing where the earnings misses have been there. So look at Tata Consumer today. That's straight away down close to about 9%. Kotak Mahindra Bank, 6.5%. So I think the mood of the market in that sense has changed because bad earnings are getting punished quite brutally.
And good earnings are getting rewarded too in equal proportion. Tejas Networks is a case in point. But there are multiple one-offs in that, I guess, because of the PLI schemes.
Which is why I think the stock has also come off. It opened straight away 20% higher when you looked at a 6x jump in the company's revenues. But now it's still up 13.5%.
IndiaMark is also one of them, right? Getting punished because of the results. They're almost 15% down is IndiaMark as well. So we are in a market where good earnings are getting disproportionately rewarded and vice versa as well. IndiaMark, some downgrades coming in as well, and that will be the stock that will be on our focus as the start of the show as well, right? Reema, what was driving the stock low, right? There's the poor quarter, I guess.
So for starters, if you look at the reported numbers, they look fine. Right? An 18% revenue growth. You've seen your margins expand to 38%, almost a 10 percentage point increase in the company's margins. Bottom line has gone up by 95%. But there are there you have those numbers. But there are three key reasons why the stock is under pressure. One, the paid subscribers. Historically, 2 years back, paid subscribers used to be about 5,000 to 6,000 every quarter. Then the company went ahead and did some price hikes. Right? That price hikes resulted in a lot of churn. And since then, the company has been struggling on adding paid subscribers. And this quarter, too, again, it's not a number you want to, write home about. It's an average sort of a number in line with the last 4 quarters. That's reason number one. Two, collections for the company have come down very sharply. And the company said that we just got caught on the wrong foot. There were execution challenges. So last quarter collection growth was 14%. This quarter it's down to 5%. And the third reason is this jump in margins from 27 to 38%. The company said is because we're not able to add so many net subscribers. The churn is very high. The focus right now is on cost optimization, which is pushing up margins in the near term. But once the paid subscriber growth picks up and growth is back, then sustainable margins will be 33 to 34%, not the 38, 39% that we've seen. So these are the three reasons why we've seen the stock see a very sharp sell-off. And there is a Jefferies downgrade too. And from a buy, they've gone straight away down to an underperform.
And there's a very sharp cut in price targets as well, right, from Jefferies, and it's showing up in the stock price as well. 15% lower on IndiaMark at 25.58. Earnings reactions, we'll get to Rakshit Ranjan, portfolio manager at Marcellus, who's joining in this morning. Rakshit, good morning. Thank you for joining in. We're just talking about this fact, right, that you are in a market where good earnings are getting rewarded, but the bad earnings are getting hammered, and how. You can see that being a case in point with IndiaMart, or even with negative news flow related stocks like PNC Infratech. But what I wanted to ask you is, have we come to a point where the margin for error for any company is absolutely zero, right? For any blip gets a IndiaMart kind of a reaction.
Yes, I think that's fair to say, because how valuations had traded all over the last, say, couple of years, wherever earnings were not sustainably backing those share price up moves, the disappointment in earnings, which is across the board actually, this quarter, most companies, as you're rightly picking up, are reporting weakness in earnings. And this is not a one-quarter blip. I think I don't think for some of these companies, the kind of earnings that they reported in a temporary manner in the last 1 or 2 years was sustainable. So negative reaction should be expected for stocks where valuations are rich but earnings are not sustainable.
Amongst the stocks that you own, Rakshit, which are a part of your various portfolios, have you seen any big earnings disappointments there?
Yeah, not really. I mean, there was Tata Consumer over the weekend, which is part of our portfolio. That's the only one. Otherwise, For instance, the stocks in our portfolio in general, they've been outperforming on the share prices and earnings. So HDFC Bank is a large holding in our portfolio, and there are several others as well where this September 30th quarter, we expect significant outperformance on both EPS growth as well as share prices.
Swing with the Tata Consumer now. What is the approach that you're taking after this kind of a fall? Are you looking to add, or will you wait? Are you expecting in the near term some more time correction and therefore or price correction? What's the call now?
Well, so let me put it this way: that the business is actually under a significant capital allocation transformation for the last couple of years, and that's the reason why we've added it to the portfolio. We see that playing out well. What happened with their tea portfolio was more external environment related impact in the second quarter, which we don't see as being a meaningful drag on our view on the next, say, 3 to 5 years of earnings potential here. In general, we see the same pattern being followed by quality companies, which are likely to outperform the rest. So rather than doing more of the same, there's a bunch of quality companies which are adding newer growth drivers to their core. And that's where I think, whilst we expect the broader quality pack to outperform the rest of the market, but within the quality pack, we expect the capital allocators, particularly highly enterprising capital allocators, to outperform the rest of the quality universe as well. So that's the way we would approach companies like these.
What about city gas distributors, Rakshit? The news that came in on over Thursday and Friday, and the kind of reaction that you saw in stocks like IGL and MGL over on that session, do you think that was overdone when it comes to the news flow? Of course, the announcement itself is a negative, the lower allocation that is going to come to them. But the kind of reaction that you have seen, has the street already priced that in terms of that one session reaction, or do you think that there is still more in terms of earnings downgrades and further pressure to come for these companies?
Yeah, no, we've managed to stay away from this entire space for precisely the reason that the drivers and the growth drivers, the margin drivers for many companies in this space are not entirely in the control of the management team. There are too many external factors, and external factors bring uncertainty and significant change in the growth prospects of revenues and earnings for such companies, and hence we've managed to stay away.
Any other interesting trends where you may not have invested, but you are liking the early signs?
Yeah, so I think different sectors, different trends. So, for instance, in the lending space, I think the gap between the boys and the men on both asset quality, particularly, and also a little bit on the net interest margins, I think is going to show up now. It has started. It will only intensify. This should be the reversal of the last 2-3 years, where gross NPAs and net NPAs were only going down for everybody in the industry. So that's certainly a trend, a separation of boys from the men in the lending space we see going forward. I think in the consumption pack, there should be companies which do a lot of company-specific initiatives. So, for instance, Trent continues to be the largest allocation, amongst the largest allocation in our CCP fund. Because whilst all the retailers, all the supermarkets in general will be reporting weak earnings given the weak broader consumption macro, but there'll be specific companies like this where they'll have too many company specific tailwinds to their fundamentals. So that should be the broad trend in consumption. There are some home building material companies in our portfolio where we see consensus upgrades coming through, given the way the consensus had actually factored in a lot of negativity related to competitive intensity and its impact on fundamentals, and hence we are sticking to some of those building material names as well. So those should be the broad patterns. More bottom-up, company-specific stock picking. The broader macro is weak. Valuations in general for the stock market are expensive, and earnings in general for the stock market will be weak. So stock picking bottom-up as outliers is the way forward.
All right, Rakshit, thank you so much for sparing time and taking us through your views on the markets and on specific sectors and stocks as well. Rakshit Ranjan there of Marcellus. Time for a short break. Up next, we discuss everything commodities. Manisha Gupta joins us on the other side. Stay tuned. Welcome back, and shifting focus now to the commodity space. Manisha Gupta is joining in, and today we are focusing on some very, very precious metals. Manisha, good morning.
Well, thank you for that, Hormuz. If I said this is the year of gold and silver, I won't be wrong. With the kind of gains that we've seen and with the kind of outperformance that these two precious metals have put out vis-a-vis other asset classes, it has been quite on the stronger side. So when it comes to gold, we are trading at all-time highs in the Asian markets right now. It is hit above $27.30 an ounce as well, and still counting. It has been a very strong gain there. If you look at the prices on a week-on-week basis, we are up by 3%. We are up 4% on a month basis. And for this year in the international markets, the gold prices have gained by 33%. This is the best gain on an yearly sense that you have seen in last 14 years. So very, very strong gains continuing in case of gold there. If you look at the Indian markets then, and there's a comparison with the international markets also, well, there are a couple of factors when it comes to Indian markets. One, it is about the rupee depreciation, which has supported. And even if you look at the Indian markets not gaining as much as the international markets, that is because of the 9% import duty cut as well. So that is a feature that is coming into the markets as well. So this is in last few years where you have seen Indian prices continue to outperform gold. It's only been in this year that you have seen Indian gold prices gain up by 22%, while the international gold prices have gained up by 33%. And not just gold, the silver prices have been on a surge as well. The international silver prices are trading at around 12-year highs. We have hit $34 an ounce there as well. In the last 1 week, we've seen silver prices gain up by 8%, 11% up in last 1 month, and 42% in this year until now, clearly outperforming not just gold, but various other asset classes as well. Well, we are looking at the Indian silver prices also on a higher note there. We've seen prices gain up by almost 26% in India. It has been a good run-up that we've seen. Of course, 45% of gains in 2020 is something that we haven't seen repeated yet again. But as you can see, last 5 years, there's only 1 year, 2021, when gold did not give you, or silver did not give you positive returns. But apart from that, it has been a one strong rally run-up that you have seen in gold and silver both. Well, the markets are looking at various support factors. One is ECB rate cut of 25 basis points for the third time. The US Fed rate cut expectation for the month of November and December as well. And then the US presidential elections, that uncertainty continues to add to prices. So it's not just Asia which is buying precious metals like gold and silver. Western world also, in sense of retail and investment, is buying gold and silver. That has been supportive. And then it has been global central bank buying, the war that continues into the Middle East, etc. And then the brokerages and global banks forecasting $3,000 an ounce for gold and $45 for silver have been other couple of factors where you have seen their clients buy, and a lot of retail and HNI also continue to buy in case of precious metals there as a safe haven. Well, going forward, there's just so much to watch out for in this week and the next as well. You have US PMI, durable goods and home sales data coming in. You also have PMI number coming in from India, Australia, UK, Japan, etc. The Europe consumer confidence numbers would be on table as well. Canada monetary policy decision also happens in this week. And next week is going to be about Japan general elections meeting. So a lot happening. And ahead of that, you wouldn't want to go short in case of gold and silver.
Okay, thank you very much for that. Time for a CNBC-TV18 exclusive. Now, sources say the GST group of ministers on rate rationalization have discussed to propose rate rejig on several items that can yield a revenue surplus of 22,000 crore rupees. Timsi joins in with the details. Timsi.
Well, that's right. What sources are indicating to us is that the GST Council nominated group of ministers on life and health insurance broadly has formed consensus. And according to them, the proposal that they are going to put forward to the upcoming GST Council in terms of recommendations of the group are likely to include a complete exemption on pure term life insurance and those pure term life insurance products covering family members. The GML is also likely to propose complete exemption on health insurance for senior citizens with no limit limits on cover. They are also likely to propose an exemption on health insurance up to 5 lakh rupees of covers for the non-senior citizens category. When it comes to the other GOM on rate rationalization, over there, the consensus is towards having overall rate rejig. Over there, the view is that this rate rejig exercise is going to give a revenue surplus of 22,000 crore rupees, which is going to help the GST framework overcome the losses that they are going to incur because of the exemptions giving under the life insurance and health insurance category. Some of the proposals where a rate hike is going to come is going to be a hike of GST on shoes above 15,000 rupees per pair from current 18% to 28%, a hike of GST on wristwatches above 25,000 rupees from 18% to 28%. Reduction is likely to come on the GST that we pay on 20 liters and plus packaged water, where the reduction is likely to come from 18% to 5%. Bicycles less than 10,000 rupees are likely to be reduced to 5%. Exercise books to be reduced to 5%. So overall, a lot of exercise is happening. Several items are likely to be under the rate rejig category, the rate rejig exercise. Let's see what are the final recommendations that both the group of ministers make when they meet next in the GST Council. Back to you.
Kimsey, thanks a lot for sharing those important updates. Time for another break. The management of Yuko Bank joins us on the other side to discuss their second quarter numbers and, of course, the way ahead for FY25. Stay tuned.
Welcome back. Let's shift our attention now to the earnings season. Now, Yuko Bank saw its net interest income, NII, surge by 20% and profits went up 50% on a year-on-year basis. But the slippages also went up very sharply, close to about 80% on a quarter-on-quarter basis. To talk about the way forward, Ashwini Kumar, MD and CEO at Yuko Bank, is now with us on the show. Thank you very much, sir, for joining in. First, if you could talk about your slippages. Slippages up 80% quarter-on-quarter and now stand at 864 crore. Is this what led to this increase? Some more color on which segments? And what would be the slippages going forward for Q3 and Q4, where you would have some visibility? Will it be at similar levels or can we expect a moderation?
Thank you for having me on the show. Just to give you a flavor about the slippages during this quarter, let me tell you that during this quarter, we had one large corporate account which turned NPA, having exposure of around 245 crore. That led to elevated slippages plus some agriculture impact, because in September quarter, agriculture slippages are on a little bit on the higher side every year. So these are the two main reasons which led to slippages increase. And one more thing, that the account which led to slippage in corporate segment, we have already provided for 50% as a provision against that account. And going forward, I expect that the slippages will be in the normal range, which were there in the previous quarters, less than 500 crore. And it will not be elevated to the level which is seen in this quarter.
Mr. Kumar, good morning. Thank you for joining in. You said you provided for 50% of the account that recently slipped into an NPA. But what about the remaining 50%? When do you expect to provide that for? And part two of my question is, there was a massive write-off as well during this quarter. Why have recoveries been on the lower side this time around?
The remaining amount we will be providing in the normal course of business, maybe in the next quarter and going forward. And so far as the recoveries are concerned, we had total recoveries of more than 900 crore. Major recoveries were in the write-off accounts also. So total recoveries put together were more than 900 crore from the various accounts in this quarter. And the slippages were, I told you, in the main account, one main account was there. And going forward, we expect that the slippages we will contain and the recovery and upgradation will improve next quarter onwards.
Do you have a gross NPA number which you could end the year with?
Our target is that we will be ending with less than 6,000 crore gross NPA. This is what the guidance we have given at the beginning of the year.
Okay. So 6,300 crore was the gross NPA in the current quarter. Will come down to below 6,000 on a quarterly run rate by Q4 end. What about, sir, on the deposit growth? Because your CD ratio is fairly comfortable, 70% lower than many of the peers. What are you targeting by way of advances growth and deposit growth for the current year?
The current year, we have given a guidance of 8 to 10% of deposit growth, and during this quarter, we clocked a deposit growth of 10.57%. And advances growth, we have achieved 18%, though the target we have targeted is 12 to 14%. But to achieve CD ratio of 15%, I think 75%. I am sure that with the deposit growth of 8 to 10%, we'll be able to achieve 75% of CD ratio by this year end. We are using our TEPS market, excess SLR securities, to raise funds from the market, so that once we achieve 75%, then we'll have another round of deposit raising aggressive plans also.
Would you look to increase your advances growth? Because it's currently higher than what your guidance is.
Yeah, our guidance continues to remain the same, but even if the opportunity is there where we get a profitable business opportunity to lend at a reasonable margins, then we will improve our guidance also. But currently we continue to have our guidance of 12 to 14%.
One final question from my end, Mr. Kumar. What was the margins, the net interest margins you had during this quarter, and what do you expect to end the year with? And if I can add one more question to that as well, which is not related to NIMs, but you have many accounts which are currently at the NCLT. What kind of recovery do you expect from those in the next 6 to 12 months?
Currently, this quarter, we recovered around 400 crore from accounts through NCLT. And next quarter, there are certain resolutions in pipeline, and certain liquidations are also in pipeline. We expect a good amount of recovery, but exact numbers, it will not be possible for me to give unless we get a resolution plan and everything on table. Second thing, you asked about the credit growth. I already talked about credit growth. 12 to 14% of credit growth we will be making in the next quarter. NIM, we have improved our NIM. A year back, our NIM was 2.84%, and now we have reached a global NIM of 3.10%, and domestic NIM of 3.26%, 3.30%. And NIM is aided by our increase in NI also, well supported by our cost reduction also through CASA, maintaining our CASA 38%.
Okay, thank you very much for that. So finally, now we know who's buying stake in Karan Johar's Dharma production. It's Adar Poonawalla-based company. There were so many rumors. First, it was Saregama. And pull up a one-month chart of Saregama, and you would see how the stock first went up, and then in the last couple of days, it's been profit-taking. Then after the rumors about Saregama died, there was rumor about Reliance Industries as well, potentially being interested. But now that flash once again will come up. I think it's about 1,000 crore in terms of
a 50% stake.
For a 50% stake in Dharma production. We'll get into a break. We'll come back and talk technicals with Soni Patnaik. Stay tuned.
Back with us here on Trading Hour. Good time to get in Soni Patnaik of JM Financial to get a quick chart check. Soni, good morning. Thank you for joining in. That recovery in Friday's session just appears to be very short-lived, right? Do you see another dash back towards Friday's lows of 24,560? Or do you see that there is, okay, we might halt at the recent 24,690 levels and then bounce from there? And couple that up with your stock recommendations as well. Sorry.
Good morning, Hormas and Rima. Thank you so much for having me on the show. So I think Nifty is in a no trading zone. The resistance is quite strong around 25,000. On the downside, 24,600, 650 is acting as a support. Any fresh downside can only be seen if the 24,650 level breaks once again, and we can see it heading towards 24,500. I think Bank Nifty is also on similar lines. It faced a short covering on Friday. It moved towards 52,500. Now it's just facing in that range of 51,500 to 52,500. So that 1,000-point range is going to be quite crucial. I think these are the two important levels to watch out for when it comes to indices, and stick to stock-specific strategy, as indices are quite volatile as of today. So the stock-specific strategy, we have buy picks for today. One would be the buy in Alchem, which is crossing above a 20 EMA hurdle today. So it's looking quite strong. It has given a good option chain breakout as well. So one can buy Alchem on small declines out towards 62.20 and keep a stop loss of 61.40. Look for higher targets of 63.50. The second buy pick comes in Jubilant Food, which has seen a very good recovery and reversal from 600 support base. So one can buy Jubilant Food, keep a stop loss of 620, look for higher targets of 650 and 660.
Thank you very much for that. Let's get to one of the biggest laggards of the day, and that's Tata Consumer. Manglam joins in with the details. What disappointed the street? Manglam.
There's 5 major things that disappointed the street when it came to Tata Consumer's numbers. The first one was the weakness that we saw in the beverages business itself. So if you just take a look at it, the organic beverages business saw a revenue decline of 3%, led by volume decline of 4% as well because of soft demand. Also, the company said tea market share dipped by about 20 basis points. Then the ready-to-drink business, which is basically, things that you buy off the streets or off the stores on the streets itself. Out of home was impacted because of unfavorable weather and also competitive pricing actions as well. Reliance's Campa, for instance, came in at a disruptive price of just about 10 rupees per serve. Growth businesses, which the company had earlier said will grow at around 30% and will account for 30% of the company's sales, are now 29% of the sales, but grew just around 15%. So 3 disappointments out there. And the foods business as well, organic revenue grew just 9% with volumes growing just about 1%. A large part of the revenue growth coming in from value-added salts portfolio. The management has said that tea business was impacted by subdued category trends, and they're starting to see synergy benefits from Capital Food and Organic India. That explains why the EBITDA margins did not deteriorate. The internals were weak. The silver linings, our international business has seen margins improve from 10% to around 15%. And also Capital Foods and Organic India is scaling up well, 25 and 45% up quarter on quarter. But brokerages believe that these are just mild positives in an otherwise unfavorable condition, which is why, they've cut in EPS estimates by 7 to 8%. In the case of ICICI Securities, they've downgraded the stock. Goldman Sachs too, they've cut their EPS estimates by 10 to 14%. They have a target price just over 1,000 rupees. And we have Morgan Stanley, which, while it's still maintaining their overweight call, have cut the target to 1273 rupees because they believe that market share over margins is the key focus. So that is something that they will track in the very near future.
Okay, thank you very much for that. Let's talk about Tejas Networks. Now, one, the numbers look very good. Revenue's gone up 77% quarter on quarter. Year on year, the company's revenues are up 570%. Therefore, the company's EBITDA too has ballooned to nearly 380 crore. And at the bottom line, the company has reported a profit number of 275 crore. This is the highest that we've seen in the last couple of quarters. But as you can see, the stock, which opened with a 20% gain, is now up only 10%. And here are the reasons why. One, the growth was largely driven by the BSNL contract. So the company bifurcates its revenues into India Government, India Private, and India International. Okay, now here, India Government revenues have fallen, India International revenues have fallen, but India Private has contributed 93% of the top line, and that's gone up 13.7x. So majority, and the company says it in the press release, that this is dominated by the BSNL 4G related shipments to TCS. So that's reason number one. And secondly, even the order book of the company has seen a sharp fall, both on a quarter-on-quarter basis and on a year-on-year basis. So good numbers. But as I said, it's largely contributed by the BSNL deal, which is why the stock is up, but it's off from the highs. Get into a break. On the other side, another corporate conversation. We'll get chatting with the management of GNA Axles.
Welcome back. Our corporate conversations continue now. GNA Axles is the next management on the show after its quarterly earnings, as well as a 400 crore rupee capex that has been approved. To discuss more on the numbers and the road ahead, Ranbir Singh, the MD and CEO at GNA Axles, is joining us. Mr. Singh, good morning. Thank you so much for joining in. I'd like to start off by asking you about your mix this time around with the domestic and the exports. If you could share a breakup of that, and which segment during the quarter did better this time around.
Very good morning. Thanks for inviting me today on this show. We are at present, the first two quarters, first half we have closed, and our top line was almost equal to last year's top line. And this bottom line is also almost maintained. As per the requirement in the North America, Europe and domestic market, especially the off-highway is quite slow. As per the retail sales for the off-highway in India, tractor sales has dropped by 8% as compared to last year. And it's just keeping in view of the festival season, they have built up the stocks over 70,000 tractors in the market. So we were our sales in the domestic market has dropped, and on which we have covered from North America and South American sales. If we see the European market, Europe, because of the disturbances and the inflation, the overall drop in the CV market is around 17%.
Okay. So the key problem is the domestic sales, which fell by 8% in the current quarter, and that's the reason why your revenues have been on the flattish side, right?
That's absolutely right. But we were they drop in the sales in domestic as well as in the European market, but it is covered from North America and South American sales.
Got it. So for H2, what can you guide in terms of domestic sales in Europe? Will it continue to contract? Will we continue to see a single-digit kind of a fall in your revenues for the second half of the year in domestic and off-highway and plus Europe? And what about North America and South America? What's the growth that you expect in the second half?
Even if the sales in the domestic market will not improve, but we will be able to match our second half equivalent to first half or slightly better. The reason being, the North American Class 8 requirement is quite up because after 2 years, we are going to change the norms of the engine norms and emission norms. So because of that, they are building the inventories over there. So it can compensate our sales, whatever drop will be there from Europe and from domestic market.
A drop in revenues in Europe and domestic markets in second half?
There is no chance of improvement. But
no chance.
Mr. Singh, I just wanted to ask you that very question, right? Because of the issues in Europe that have been flagged by Stellantis and BMW and all the other such auto companies with the recalls as well. How much of your business has been impacted because of that? If you could put a number. So you've already mentioned that there is no chance of an improvement, but how much of your business is likely to be impacted because of this?
Fact is that our dependency upon percentage is very minimal. That is the SUV segment. That is a hardly less than a 5%. But we are having good visibility for those kind of areas in passenger vehicle for North and North American market. So far in Europe, because of recalls, our business is not at all affected.
So then, what about your capex plans? You've outlined a capex plan of 400 crore rupees, which you will invest over the next 3 to 4 years. What would be the peak production of this, therefore the peak revenues? Does it come on stream 4 years later? And how will you fund it, sir?
Rima, about this 400 crore capex, which we have taken clearance from the board, the allocation of the funds are going to be like that, over around 50% will be invested for renewable energy, that is mainly for the solar, and part of that will be invested for EV new component development, and keeping the vision for 2027-28 for the EV component research and development and its manufacturing and prototyping and so on. And the rest of the funds are for the augmentation of our existing plants, where we want to create more flexibility and want to increase the efficiency. Those funds will be utilized. And after these fund deployment and all, we are targeting from next year onwards 8 to 10% growth.
You mean 8 to 10% growth for FY26, if I heard that correctly, Mr. Singh?
From 27 onwards, we are targeting 8 to 10%, but by 2028, our revenue over 10% we are targeting out of EV components.
All right, Mr. Singh, thank you so much for sparing time and sharing with us your views on the road ahead. Wish you good luck for the second half of FY25. The management of GNA axles the stock at the lowest point of the day, 1.5% lower at 416. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned. Welcome back. The market has taken a bit of a dive from when we began the show. It was a bit of quieter start to the show, but now the Nifty has now slipped towards levels of 24,750, currently 100 points lower. Kotak Mahindra Bank continues to remain the top drag on the index, 5.5% lower. ICICI Bank has now joined that list. That stock is also down 1%. Infosys is contributing to the downside. Tata Consumer has been a slight recovery from the lows of the day, now down just under 7.75% from a 9% drop. But HDFC Bank holding on to the gains, currently trading over 3% higher, holding on to any further index downside. So keep an eye out on some important levels on the Nifty. But with that, it's a wrap on this edition of Trading Hour. From Rima, me and the team that put this show together, thank you so much for watching. Halftime Report takes the action forward.